Welcome and hello. Welcome to the Go Plan video library that includes Greenleaf Financial Fitness Series and other financial professional series involved with personal financial wellness. This series, along with other videos, will be posted on our Go Plan YouTube channel, websites, and other social media outlets. My name is Jim Hiles, and as your host, I think it's important to highlight what financial wellness is and how tools like Go Plan 101 can help Americans achieve their goals and wishes. So, what is financial wellness? It is defined as the overall financial health of an individual. What it does for you is probably most important. It helps you increase understanding all things related to money. It can also help decrease stress, help you make better decisions, and perhaps most importantly, keep you on track as things change in the future. What's Go Plan 101? Well, Go Plan 101 combines web technology and educational content with behavioral change solutions, free software, and a huge resource center full of focused responses. Translation? Simple. Go Plan 101 is a cool site that helps people deal with their money issues so they can do what they want to do. And you also have the capability on our site to talk to a coach or go right to the resource. At the end of the day, financial wellness is only as good as the actions taken. So sit back, relax, and enjoy the video.
Good afternoon and welcome to today's broadcast of the Greenleaf Financial Fitness Series. Our topic today is unlocking the secrets of Social Security, where we're going to spend some time exploring this benefit that we find many people would like to learn more about. I'd like to take a second just to introduce the people who make these broadcasts happen. Up top, we have Jamie Greenleaf, principal of Cafaro Greenleaf, Jim Hiles here with me today at Greenleaf Financial. Jim's also managing partner of First Capital. Today we have a special guest, Matthew Allen. Matt is the co-founder and CEO of Social Security Advisors, and I'm Jim D., a financial advisor with Greenleaf Financial. So we have a lot of material. We're going to have to move pretty quickly today to keep true to our 20 minutes. Jim, why don't you tell us a little bit about why we financial planners are doing this webinar in the first place?
Sure. Good afternoon, everyone. This is Jim Hiles, and Social Security is one part of the financial planning. The financial planning life path that we're all on generally is akin to, accumulating enough money to you can retire essentially. And retirement is just part of a financial plan. And when you do a financial plan, you certainly want to look at all aspects of the estate, the college planning, insurances, investments, taxes, and everything. Today, we're going to look at just the retirement planning piece, and more specifically, drilling down into Social Security planning. So Social Security may be and is likely to be your largest single retirement decision. If you think about adding up all the benefits that are potentially out there for people, you could be looking at $1 million decision here. So it's a pretty significant decision. You want to make sure you get it right. Plus, it's kind of a unique set of circumstances because it's tough to find an expert in Social Security, and it's complicated. In fact, Social Security itself is legally prohibited from providing advice, and most financial advisors don't know advanced filing strategies, which is why we have our guest speaker on today.
Right, and there are also a lot of myths out there that we find, and we'll be addressing many of those today. The first one that we hear from everyone is the system is running out of money, better claim it while you can. Also, a lot of people feel like it doesn't matter when I claim, money is money. Third, if you work while receiving benefits, people want to know what happens there. And according to my statement, it seems like I should claim either at 62, 66, or 70. Matt's going to talk about that. And the other myth that Jim just touched on is Social Security Administration will help me figure it all out.
Yeah, that's a classic, and God bless them for helping out, but sometimes they get in their own way. And other things we look at in terms of myths are if there's a divorce scenario, the divorced spouses can't collect on the ex-spouse's Social Security, and that's simply not the case. That there is no optimal claiming strategy for single individuals. That's not necessarily true either. There are different strategies even for single individuals. What if you delay it to age 70? Does the spouse get 50% of this benefit? So not necessarily the case either. So another thing we'll be looking at today. How about this one? Social Security benefits are tax-free. Whoa, got to be careful here because you could have an income tax situation. You could pay income taxes on your Social Security benefits. And lastly, a Social Security cannot be undone. I am stuck by my mistake. You're going to find out that that is not necessarily the case.
Right. Now, we want to see people get as much money as possible from Social Security. It's a benefit that you've earned. And a lot of people don't know or realize that 70% of Americans fail to maximize their full benefit. And if you're a married couple, over a lifetime, it could cost you $120,000 as a couple with the wrong claiming strategy, which means people are missing out on a lot of benefits and leaving $25 billion in total on the table per year by not claiming properly, which is obviously a lot of money.
So why? It's complicated. You're going to find, even when you look at your statements, it can be somewhat intimidating to figure out what you need to do. And here's why. There are 2,728 rules on Social Security. Imagine playing a card game with 2,700 rules. There are over 9,200 strategies, variations that you can do with your Social Security. And so basically math is involved here, and Social Security is like one big math problem. You got to sit down and figure it out.
Okay, now we're going to bring in Matthew Allen here. Matt is an expert in Social Security and created his company, one of his companies, Social Security Advisors, over 10 years ago after recognizing that there was a shortage of resources for people looking for professional guidance in this area. So welcome, Matt. Why don't you take us through the next few slides and talk about some of the basics for us?
Sure, I'd be happy to. And thank you so much, Jim Hiles and Jim D, for having me on. I appreciate it.
You're welcome.
In general, what you should know is that your benefits are based on your highest 35 years of earnings. So it's absolutely critical to obviously maximize what you receive while you're working. But basically, when you look at your Social Security statement, there are variations that everyone generally sees between 62 and 70 years old in terms of what is listed there on the statement. Most people tend to focus on what is called, quote unquote, your full retirement age at 66. And unfortunately, that is generally not the optimal time to be claiming. But what you should know in general is that between 62 and 70, your benefits are increasing at approximately 8% per year. In terms of the actual particulars of when you should be claiming, the biggest thing to focus on for the vast majority of at least clients that we see on this end, because most of our clients are married couples or divorced spouses or survivors, is that in those cases, it's especially critical to coordinate when you file because you have what in many cases is what's called dual entitlement. You can actually claim on one record and basically let the other one grow. So it's very important to coordinate. That's what most folks fail to recognize. They tend to think of their individual situation as opposed to actually coordinating together.
Okay.
The other issue here, yeah, go ahead.
Oh, sorry. I'm sorry. Continue. Going on that one?
Yeah, sure. I'd be happy to give you an example here of a married couple. Basically, what we have, Susan, we're going to say that they both have actually similar full retirement age amounts of $2,000 just for purposes of this example. But they have a 4-year difference between their ages. So John's 66 years, Susan's 62. It's actually a typical spread, it's for a regular couple. And one of the strategies as an example of something that can be used under some of the previous Social Security rules is that Susan could actually file for benefits on her own record and start receiving benefits. And then John actually could use something called a restricted application to file only for spousal benefits. Basically, anyone born prior to January 2nd of 1954 still has the ability to use this type of strategy. And so he could start using that restricted application. What that would mean is that even though Susan has her benefit reduced because she'd be claiming it early, so she'd only get about $1,500 now because it gets reduced down to about 75% if someone claims at 62. What it does allow for then, and this points to my point of coordination, it gives John the ability to start getting $1,000 a month. So together they're at about $2,500 a month. On top of that, John's own benefit would continue to grow at the rate of 8% per year while he's getting that $1,000 a month. So between 66 and 70 in this example, he's picking up about an extra $48,000 as a spouse, and he's increasing his own benefit by about 32%. So it goes up to about $2,640 by the time he switches at 70. What that means for them as a couple, if you run the numbers on this, is that over their joint life expectancy, they should get, in terms of just average life expectancy, about $106,000 more. If they had a longer than expected life expectancy, it's even more beneficial, about $161,000 more.
Okay, that's one of the 9,200 strategies we talked about up top, right? There's a lot of strategies, and that's a lot in one strategy.
Exactly.
So obviously, kind of tells us why we need help.
Yeah. To talk a little bit here about the deemed filing rule, basically this is just a fancy way of saying that if you apply for benefits prior to your full retirement age, Social Security is going to consider that you have filed for every type of benefit you're eligible for. So going back as a quick example, just to what we were just talking about with John, if he had tried to file for that restricted application, let's say at 65 instead of 66, which is his full retirement age, they would have actually paid benefits on his own record, and he would have ruined the ability to get the spousal benefit and also the delayed retirement credits as well. So it's very important to be careful about when you file, because this deemed filing rule is, of course, again, one of those 2,728 rules, and a lot of people get tripped up on that without recognizing it.
I could see how that would happen. So what about survivor benefits?
With survivor benefits, there's a lot of strategies available there too. Generally, the way that survivor benefits work in a nutshell is that when there's a married couple and one spouse eventually passes away, the survivor gets the higher of the two benefits. So when thinking about your Social Security strategy initially, when you're about to claim, you want to be very careful to make sure that you're claiming as a married couple so you maximize any eventual survivor benefit. Normally what that means is basically at least having the higher earner delay benefits and implement a strategy that allows for additional credits to build up, because that will actually provide the most amount of protection for both of them for a couple. Especially married couples, you have to look at joint life expectancy as opposed to, again, individual life expectancy. Way too many people, think again about their own situation without recognizing how it's going to help or hinder their spouse, actually.
That makes a lot of sense. So coordination is more important than it even seems on the surface when you start to think about those type of issues.
Absolutely. Yeah.
So give us
there are some general rules of thumb. Yeah. Basically, for the lower earner in a couple, generally speaking, should be the one to be filing early, or at least considering to be filing early, while the higher earner delays as late until 70. Basically, delayed retirement credits stop accumulating at 70. So no one should wait beyond 70. They'd just be leaving money on the table. But that is generally the structure for that type of earning situation for the couple. What that will mean also then, when the higher earner eventually does file, typically the lower earner will end up actually receiving what's called a supplemental spousal benefit. So their benefit that they've been getting will end up going up as a result of that.
Very good. Thanks.
Sure. No worries. In terms of the rules of thumb, though, for those that have similar earnings histories, there it's a little bit more of the situation where both spouses generally should try to get as many delayed retirement credits as they can. That would keep building up again as late as 70. Except an important caveat there is that if there is at least one spouse in the couple born prior to that January 2nd of 1954, they want to definitely be consider using that restricted application strategy that we talked about in the John and Susan example. So just it's important to not forget to use that.
Matt, quick question for you, and you go back to that slide. It
Sure.
seems like a lot of the strategies have to do with deferring, pushing it out a little further, depending on what you're doing. And then we got the question, texted into us about, well, what if Social Security isn't there? What is the current opinion as to how to view that?
Sure. And thanks, Jim. Basically, what we always tell clients is don't worry about that issue too much, because this is not the first time around the merry-go-round on this from a political perspective. Last time that this sort of fiscal issue was dealt with was back in 1983 under what was called the Greenspan Commission. And they basically made a couple of tweaks at that point, increasing the payroll tax cap, increasing the full retirement age amount, also changing the way the cost of living adjustment is calculated, et cetera. And the next time that Social Security is supposed to, quote unquote, be out of money is in 2034. So we're dealing with still about a 16-year problem. The interesting thing when we looked at this is that politicians generally have a tenure in office of about 10 years. So they have a big incentive to keep kicking the can down the road. The other thing, though, and the reason we tell clients not to worry about it too much, at least those that are over 55 at this point, is because even the more conservative politicians proposing changes generally are factoring in grandfathering clauses for anyone 55 and older at the current time. So it's better to focus on the existing rules and what you can do, as opposed to what may or may not happen at some point in the future. It's just, it's a little bit out of the hands of any kind of one particular voter, if you will.
Got it. That makes sense. So now you're going to do a divorced couple example for us, right?
Exactly. Yeah. And I'd be happy to show you this example. So we're going to stick with kind of a similar thing here, basically with John and Susan, same ages and same benefit amounts to start. So $2,000 for each of them. And what the important difference here, though, is that for a divorced couple that's been married for at least 10 years, so that's one qualification, they had to be married for at least 10 years. But if you recall from the other example where Susan needed to file previously, for a divorced couple, as long as they've been divorced for at least 2 years, that means that John could actually file for this restricted application, even if Susan did not file. So that's a critical difference here, because sometimes divorced spouses don't even know if their ex-spouse has filed for benefits. So that's why Social Security has built this in there. So John can basically still pursue a similar strategy for himself, where he files for these spousal benefits, waits until 70 to switch over to his. And if he does that, it's going to be about $62,000 more just for his side of the equation, and over an average life expectancy, and about $104,000 over the long term. So,
okay, great. I don't see anything
different.
Is there a rule about how long someone has to be married before they use this strategy?
Yeah, it's 10 years actually is the minimum. You have to have been married for at least 10 years. And then you're able to implement this strategy or get benefits. Even if it's not this particular restricted application, you're still able to get divorce spousal benefits if you've been married for at least 10 years.
Got it. Okay. We had a couple other strategies in here. I don't know that we're going to have time to cover the next couple of them and still cover what we want to cover at the end. So I might just say that we're going to kind of move through these. People realize that they can print the handouts out. Of course, they can watch the webinar again. And of course, we're going to give them a way to contact Social Security advisors at the end. So maybe we just skip through the next couple of slides.
Okay.
But this one, I'd like you to talk about a little bit if you could, Matt.
Sure, I'd be happy to, Jim. So the earnings test is another important point when you're under your full retirement age. Basically, what that means for most people is 66 years old. And if you apply for benefits and you're working when you're under full retirement age, you have to be very careful not to exceed this earnings test of $17,040 per year. That's the 2018 limit. And if you do, what ends up occurring, so let's say somebody is, just for simplicity's sake, let's say about $27,000. So they're about $10,000 over in their job that they're earning that. What ends up happening is that Social Security withholds $1 in benefits for every $2 that you're over that test. they'd end up withholding actually about $5,000. For higher earners, they often get tripped up on this because they'll file for benefits at 65 or 64 without taking into account the earnings test, only to find that they actually have their entire benefit completely eliminated. And what happens is that actually then often locks them into more negative consequences going forward, not only for themselves, but the spouse. An important thing to take into consideration, though, is the earnings test does go away or disappear at full retirement age. So at that point going forward, you can get Social Security and earn an unlimited amount of money with no problems.
Got it. Yeah, so that could really trip people up. So quickly, why don't we cover the next couple of slides, and then we'll talk to people about how to get in touch with you.
Sure. So again, that top portion there was just the dollar for every two that I was mentioning. But in the case here of taxation, if you want to go back to the tax one, I think we covered most of the earnings test here. So for taxes, though, there's unfortunately not a lot of great ways around it. A lot of people are surprised to find out that their benefits are subject to tax. They have something called the provisional income formula, which is basically a special formula from the IRS. It's your adjusted gross income, or your AGI, plus tax-exempt interest, like municipal bond interest, and 50% of your Social Security benefits. And if you flip, Jim, to the next slide, I'll show you the chart here that is important. Basically, and this is just showing you obviously by filing status, if you're over the second thresholds that's listed in the right-hand column, like let's pick again just a married couple here filing jointly, if they're over $44,000 with that figure from the equation that we just showed you, basically 85% of their Social Security benefit is going to be subject to tax at their marginal rate. So there is a little bit of a tax break, unlike regular work income. 100% of that is obviously subject to tax at your marginal rate. So there's a slight tax break, but it is subject to tax on the federal level. There are 37 states basically that do not tax Social Security, but again, on the federal level, it's a little bit more difficult to avoid.
Got it.
Yeah. A big surprise for many folks is that actually other family members can be eligible for benefits. That would be minor children, for instance, under 18, or that were disabled prior to 22 years old. Also, if a spouse is caring for those minor children, they can be eligible for benefits. There is a family maximum, though, of it's called the family maximum benefit, and it's basically 185% of the worker's full retirement age amount. But it's just something to keep in mind because folks often miss out on those. The other thing, just to point out from a benefits perspective that the Social Security Administration administers is the Social Security Disability program. And to qualify for that, you have to have worked, of course, in jobs where you're paying into Social Security. You have to have a medical condition that qualifies. And what that basically generally means is that you're unable to work for 1 year or more as a result of that disability.
Good. I think, we covered a lot here in a short period of time. And people ask us, well, how do I find out more about it? And what do I need to do to figure out how to file a benefit? Well, I think we have 5 different choices here for people to do. If you want to do it yourself, you can certainly go online to socialsecurity.gov. And you can see the link on here, and it'll be on the material afterwards. You can certainly call Social Security and visit one of their offices. Or you can go through a professional filing service like Matt's company at socialsecurityadvisors.com. In any event, if you have any questions on this or any other related financial issues that you may have, whether it be investing or insurance, retirement, then you can always call Greenleaf Financial to get that started. Here is Matt's income or information for determining whether or not you can get a Social Security analysis. And keep in mind, this is the first consultation is complimentary. So here's the site, here's the phone number. So feel free to reach out to him directly if you want to learn more about Social Security Advisors and what their services are. So we covered a lot of ground, and let's just summarize. It's time to put this information to work. We live in a wonderful and a free country, but it's up to us to take responsibility and move forward, particularly on our personal financial wellness. So let's take some action here. Let's go and explore this financial stuff. Take a buddy with you if you need to. have some fun. Learn a little or learn a lot about what you can do financially. These videos and websites, I hope you enjoy. I think they're great. But if you're like me, sometimes you just want someone to talk it out with. So seek out coaching from our site from professionals who've been vetted to provide you with complimentary initial consultations as being part of the Go Plan 101 experience. If you've not started your planning, or even if you have, use today's video to explore the area of concentration. Make sure you understand how it impacts you. My favorite quote is, life doesn't go in a straight line. You need to stay on top of it. So consider subscribing to our newsletter or our YouTube channel. Please reach out to me if you want more help or have questions. And lastly, thank you for listening. Now, go plan and go attain your financial wellness goals. Jim Hiles signing off for today. Take care.